Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Exotic Options Explained, a guide to types, benefits, and risks. Complex financial strategies often demand tools that go beyond the basics. This is where exotic options come in. Unlike standard options, these contracts offer unique features that cater to specific market needs. They're designed for traders seeking tailored solutions or looking to manage unconventional risks. Exotic options play a vital role in modern finance, providing opportunities for creativity and precision in trading strategies. Whether you're curious about their structure or their advantages, understanding these options can open new doors in financial planning. What are exotic options? Exotic options are a type of financial derivative that differ significantly from standard options. While traditional options like calls and puts have straightforward terms, exotic options are more complex and customizable. They are often created to address specific needs or market conditions, making them a popular choice for advanced traders and institutions. These contracts can involve non-standard strike prices, payoff structures, or underlying assets, offering flexibility that standard options lack. Types of exotic options. Exotic options come in various forms, each tailored to unique trading scenarios. Below are some of the most common types. Barrier options. These become active or void depending on whether the asset price reaches a set level, the barrier. For example, a knock-in option activates only after the price hits the barrier, while a knockout ceases to exist once the barrier is breached. Asian options. Instead of using a single price point, their payoff is based on the average price of the underlying asset during a specified time. This can reduce the impact of market volatility. Digital options. Also known as binary options, these pay a fixed amount if the underlying asset meets a specific condition. If the condition isn't met, they result in no payout. Chooser options. These allow the holder to decide later whether the option will be a call or a put, offering flexibility. Look-back options. The payoff is based on the most favorable price of the underlying asset during the option's term, either its highest or lowest value, depending on the contract. Compound options. Often referred to as options on options, these give the right to buy or sell another option at a specific price. This list isn't exhaustive, but it highlights the diversity within exotic options. Each type is designed with a particular strategy or goal in mind, catering to unique trading needs. Features of exotic options. What sets exotic options apart from standard options? Here are the key features that make them stand out. Customizable structures. Traders can adjust the terms of exotic options to suit specific market conditions or investment strategies. This level of customization is not available with standard options. Complex payoff formulas. Exotic options often have payouts tied to conditions like asset performance over time or specific triggers. This allows for tailored risk-reward profiles. Lower costs in some scenarios. Depending on the type and terms, exotic options may be less expensive than standard options. For instance, barrier options often have reduced premiums due to their conditional nature. Access to niche investments. Exotic options frequently involve underlying assets or strategies not covered by standard options, opening the door to specialized opportunities. Enhanced risk management. They provide investors with tools to manage non-traditional risks, such as mitigating extreme price movements or hedging against multiple variables simultaneously. By combining these features, exotic options give traders the ability to build strategies that are as creative as they're precise. They're not for everyone, but for those with the expertise, these tools can be incredibly powerful. How exotic options work. Exotic options are tailored derivatives that allow traders to execute unique strategies or hedge unconventional risks. Their appeal lies in the complex features and specific conditions that set them apart from standard options. To fully appreciate their potential, it's essential to understand how they are priced and valued, as these mechanics influence their usability in the market. Pricing exotic options. The pricing of exotic options depends on several factors, making it a more intricate process compared to standard options. Key elements influencing their cost include underlying asset behavior. The performance of the asset tied to the exotic option significantly affects its value. This could include price trends, volatility, or even average prices, as seen in Asian options. Volatility. How much the price of the underlying asset fluctuates is critical. Higher volatility can mean a higher price for options with potentially large payouts. Time to expiration. The time left before the option expires impacts its pricing, similar to standard options. Longer durations often come with higher costs due to increased uncertainty. Interest rates and dividends. Changes in interest rates or expected dividends from the underlying asset can tweak the pricing formulas. Payoff structure. Exotic options often have complex payout conditions tied to triggers or historical performance. More intricate structures usually mean additional pricing complexity. To calculate these prices, financial experts use mathematical models, which weigh these variables against market conditions. Valuation models for exotic options. Valuing exotic options accurately is paramount for their proper use. Traditional models like Black-Scholes are often adapted, while some options demand entirely specialized approaches. Black-Scholes model. The Black-Scholes model serves as a cornerstone for pricing standard options. However, its core elements are often adjusted to accommodate the conditions of some exotic options. This is especially useful for relatively simpler designs. Monte Carlo simulations. For more intricate options, such as look-back or barrier options, Monte Carlo simulations are often used. These involve thousands of hypothetical scenarios, allowing analysts to estimate an option's value by analyzing probable outcomes. Finite difference methods. These numerical methods are used to solve differential equations, accommodating features like barriers or path-dependent payoffs. They are ideal for options that defy simpler models. Binomial tree models. Binomial models break down the option's lifecycle into intervals. At each step, they evaluate price changes and probabilities, making them suitable for options with multiple triggers. Each model has its strengths and limitations. Monte Carlo simulations, for example, are versatile but computationally intensive, while Black-Scholes may fall short for highly complex structures. The choice of model depends largely on the specific features of the exotic option in question. Understanding these pricing and valuation methods helps traders not just in determining fair value but also in anticipating risks and returns. Advantages of exotic options. Exotic options offer unique advantages that make them attractive to experienced traders and investors. They go beyond the limitations of standard options, allowing for creative and personalized strategies. Whether you're aiming for targeted investments or managing risks in volatile markets, these derivatives provide tools that are as flexible as they are powerful. Flexibility and customization. One of the biggest advantages of exotic options lies in their customizable structures. Unlike traditional options, these contracts can be tailored to align with specific investment goals or respond to unique market conditions. Think of exotic options as a build-your-own strategy toolkit, flexible enough to adapt to almost any situation. Tailored payoff structures. Exotic options allow investors to define how and when payoffs occur. For instance, a barrier option can be designed to activate or deactivate depending on price levels. Unique underlying assets. They often enable trading in niche markets or assets that aren't covered by conventional options. This opens doors for investors aiming to diversify. Adaptability to market needs. Whether you're hedging against an unlikely event or speculating on a specific scenario, these options can be fine-tuned to suit the risk-reward profile you want. This level of flexibility gives traders more control, making exotic options an ideal choice for those who want their strategies to work on their own terms. Hedging opportunities. In markets where volatility can catch even seasoned investors off guard, exotic options offer highly effective hedging opportunities. They provide ways to protect portfolios against even the most complex risks. Managing multiple risks at once. Exotic options can be designed to hedge against not just price movements but also factors like market averages, e.g., Asian options, or most favorable price points, e.g., look-back options. Conditional protection. With features like triggers and barrier options, you can create contracts that offer protection only under certain conditions. This makes them more cost-effective than standard hedging tools. Limit tail risk. By setting precise conditions, investors can address tail risks, those extreme scenarios that can lead to significant losses. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.